Now, if you're not prepared, yes, retirement's challenges can indeed make you feel like you're hanging on for dear life. Always worrying, always wondering, always hoping you'll be able to hang in there. But you know, that's not the kind of retirement that most people want, which is why we're focusing on today's show, the 7 biggest retirement challenges and how to prepare for them. It's time once again to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. Hello, I'm David Scranton. You know, most of us want to look forward to retirement, and we want to be confident that we're going to be able to enjoy it and to achieve our goals. And when that doesn't happen, often it's because we haven't anticipated or we haven't adequately prepared for retirement's biggest challenges. Retirement's financial hurdles can be unique, and clearing these hurdles requires preparation, diligence, awareness, and frankly, just the right strategies. Today, we're going to discuss what I believe are the 7 biggest challenges of retirement and how they can lead to some of the most common mistakes that retirees make with their money. We'll share plenty of tips on how to prepare for these challenges and get additional insights from today's guests. Joining us are Scott Wardell, author of the book Retiring in Turbulent Times, and second, Geoff Small, author of the book Turning Financial Planning Right Side Up. But first, let's dive right into retirement's top challenges. You know, if you've been to the beautiful southwestern states, odds are that you've had some experience with the desert. You know that as topography goes, the desert can be extremely deceptive. Looking across it from ground level, its distance is extremely difficult to gauge. Many settlers traveling west made this discovery the hard way. They set forth across these huge wastelands without enough food or water to complete the trip. That's a pretty fitting analogy for the first of the 7 biggest retirement challenges facing baby boomers today. And that challenge is longevity. And the fact that people today need to prepare for longer retirements than ever before, and frankly, longer retirements than many realize. And if you are a regular viewer, you know this is a challenge that I've discussed many, many times. Why? Because it's integral to just about everything else that we talk about. You could have the most sound financial strategy in the entire world, but if it's only designed for 20 years of reliable retirement income and you live 30 years, well then obviously it's just not good enough. And the fact is that 30 years is about what most retirees today should be planning for, and that's simply based upon the latest longevity statistics. In fact, according to a recent intergenerational report, the average life expectancy for men today is around 85 years, and for women it's about 90 years. This same report indicated that 25% of 65-year-olds today are likely to make it to age 100. Now, of course, most of us would like to live to a ripe old age, provided that we could remain relatively healthy and independent along the way. But a crucial part of maintaining that health, and especially that independence, involves making sure that we don't run out of retirement income before we've hit that ripe old age. We need to meet the challenge of correctly calculating the distance of the desert that we're preparing to cross. And we need a strategy that ensures we can make it across not only without using up our supplies too soon, but without losing them in a storm or some other unexpected event. In other words, we need a financial strategy that not only provides income that we won't outlive, but one that's designed to protect the source from that income, or from a major loss, I really should say. And we'll talk more about the importance of protection in just a bit. Right now, though, let's focus on one of the other major reasons that retirees end up running out of money prematurely. In fact, I would call it actually the second biggest challenge that retirees face. And that is spending down principal. You know, as I pointed out many times before on the show, spending any principal during retirement, and especially in the first 10 or 15 years or so of retirement, can be an extremely slippery slope. It's even slipperier today than ever before, given the challenge that we've just talked about, longevity. But the fact that baby boomers need to plan for up to 30 years of retirement does create a good metaphor for explaining the danger of spending down principal. As it turns out, 30 years is the same amount of time many people choose over which to finance their home. So think about your 30-year mortgage and how it works. When you first started making mortgage payments, you're not paying back very much principal at all. Instead, you're paying almost all interest with only a tiny little bit of principal. But you know, as the years go on and the balance gets paid down, you pay a little less interest and you pay a little bit more principal. This process continues until after 30 years, somehow miraculously, the entire mortgage is paid off. But now I'd like you to imagine the same process in reverse. Take, for example, a pool of savings, a pool of money, and let's just say that pool is worth $1 million. And let's say that that pool is generating 5% interest per year, which would be about $50,000. If you take just a little bit more, just a wee bit more than that $50,000 each and every year, just a small amount of your original principal, your $1 million in savings can be depleted within the same 30 years as that mortgage was paid off. And you know, that many times is a best case scenario. When you factor in some of the other challenges that we'll be talking about, and much more likely your savings could be depleted long before this 30 years is up. We'll focus on some of those other challenges just a bit, but right now it's time to welcome Scott Wardell. Scott Wardell is a financial advisor in the great state of Minnesota, I should say Minnesota, with over 35 years of experience. He's also the author of Retiring in Turbulent Times. Scott, welcome to the show.
Thank you, David, for having me. I'm delighted to be here with you.
So, wait a minute. Turbulent times? I mean, everybody else is like thinking things are great right now. I mean, you're the only one who thinks they're turbulent. Why are these turbulent times? Help me out here.
Yeah, absolutely. Well, as everyone is very well aware, we've got a lot of volatility in markets. We've got a completely different retirement calculation for people that is very much away from the old pension-based calculation, which creates the one thing that's certain, right? Uncertainty.
Right.
And at the same time, a crazy political environment that makes people wonder, well, gosh, will Medicare even be there for me? In the past, people would ask about Social Security. Now they're asking, well, how about Medicare? Is that going to be there for me? So turbulence and uncertainty, I kind of use them synonymously in my book here.
So we're not talking about the markets per se, which I think of when I think turbulent, but in terms of uncertainty, you know, I know what you're referring to is that we've gone from the pension model to the 401k model now, where your balances could drop by 50% in a matter of a couple years, right? I mean, that happened to people twice since the turn of the century. So the question is, what can people do with their 401ks to improve, or I should say decrease the chances of that happening as they approach retirement? And then ultimately, how can 401ks be reset for distribution when people are ready to really pull the trigger and retire?
Right, David, it's a great question, and part of it really comes to the fact that 401ks are almost all set up for accumulation. And so people feel comfortable with them, and when they're adding to them all the time, they feel, gosh, you know, this is really something that has worked and continues to work, but they really are not cognizant of the fact that when they get to retirement, they got to restructure this thing, as you say, reset what it is. And you and I both know that the traditional 60-40 model, you know, 60% equities and 40% bonds, and then switch it over when your retirement is way oversimplified and antiquated. So, you know, there's a lot of things that people can do, but it really depends on a bunch of personal factors. So how big is the Social Security? Is there any pension in place at all that can help supplement the income? So getting all of that baseline income stuff in place, and then really addressing the hard question, and that is, given the amount of money we've got in retirement assets, can you afford to go backwards at all? Because some people are like, hey, the snapshot today looks good, but any backwards movement in this market, and it just doesn't work. So you really have to work with the individual to really find out how that works.
As a guy who's really talking to clients every day, as I am, you know, tell me, do you see the same thing? You know, I see there's two issues going on right now. First of all, It's been nearly a decade now since they've seen their accounts make a significant drop. And it's kind of like that convex mirror sticking out of the side of a truck, you know, the one with the warning sign that says objects may be closer than they appear. You know, makes everyone look further away, except unfortunately the 401ks don't come with that sticker. And the second thing that I see is people don't realize how much money they lost, because to some degree when the markets were dropping, the fact they were saving and contributing, on paper at least, it made it seem as though they didn't lose as much, when really it was their new money that was helping them rebound faster. Are you seeing that those are two factors also the way I do that might skew people's view of what actually happened back then?
Yeah, absolutely. And you know, that contribution, I always say to people when they're in that contribution mode, I said, remember, you're still a net buyer. And as a net buyer, what do you want the price to do? Well, with a little thought, they usually come up with the right answer. I want it to go down. Absolutely, that's fine. Buy them cheaper. But on the other hand, when it comes time for distribution, we can't afford that anymore. And you are so right, is if I could wave a wand and get my wish for how I work with people, I would have everybody come and start the planning within 5 years of what I would call the intended retirement date. Because as you know, what happens is people say, well, I'd like to retire in 5 years or whatever that date is. And then when it gets a little closer, they're like, well, it's not quite so urgent and I don't feel quite so ready. And then it gets pushed out. But if they start to work with you within 5 years of that intended date, then, as you know, there's a lot that we can do to help support and get the actual retirement and distribution plan set up.
We're here today with Scott Wardell, author of Retiring in Turbulent Times. And yeah, Scott, I mean, it's amazing. Unfortunately, sadly, we see people within a year of retirement. You see it too. I want to retire in 6 months. What do I do? And by then, it's not like we have a magic wand. There's not much we can do. Right. But with that having been said, I want you back for the next block, and I'm going to ask you to bring your magic wand. Stay with us. We'll be right back with more here on The Income Generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for your free income kit from the Retirement Income Store, where baby boomers go for income.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
So the Great Depression of the 1930s fundamentally changed America in many ways. One of those changes has to do with inflation. You may not know it, but it was during the Great Depression that we first started to accumulate permanent national debt. And not surprisingly, it's also when we fell into the habit of permanently trying to artificially manipulate our economy by manufacturing inflation. Unfortunately, both debt and inflation have become a permanent part of the nation's economy, thus creating a major challenge for American workers trying to estimate their retirement income needs. Inflation is, in fact, the 3rd biggest challenge facing retirees. Now, most people don't realize that the effects of inflation hit retirees harder than the general population for several reasons. But as a result, they underestimate inflation's impact. While working, many people can count on a periodic cost of living increase in their income to keep pace with inflation, in addition to any pay increases based upon seniority, performance, or changing jobs. Those adjustments go away after you stop working, and your income doesn't necessarily increase as prices rise. Over the course of a 30-year retirement, that imbalance can take an enormous toll. The average annual inflation rate, according to the CPI index, is said to be 3.5%. But in reality, many economists believe that it's probably much closer to 5. Why? Because the government has a bit of an axe to grind when it comes to reporting inflation data. And it's in their best interest to keep the reported number on the low side. If inflation is low, it means they can spend less money on cost of living increases, on federal pension benefits, and also on Social Security checks. Those raises are based upon the CPI, and thus Uncle Sam has a financial incentive to kind of sort of lowball that inflation rate. The fact is, inflation was over 7% in the 1970s and over 5.5% in the 1980s, and those are the official lowball numbers. Now, here's another fact. At 5% inflation over a course of 30 years, a person would need about 4 times the income their last day of retirement compared to their first. At 7% inflation, they need about 8 times as much their last day of retirement compared to their first. And that's just considering the general inflation rate. Now, the situation gets even more daunting when you factor in the 4th biggest challenge facing retirees, and that is healthcare costs. As we discussed on last week's show, for all the great things about having longer, healthier lifespans, the reality is that the longer you live, the greater odds of suffering a major health event. Now, while most people smartly factor in healthcare costs as part of their retirement plan, it is another area that is often greatly underestimated. In fact, the impact of a major health event is one of the most common causes of financial problems for retirees, including those with excellent health insurance. A serious health issue can result in hundreds of thousands of dollars in bills for hospital stays, medical procedures, and prescription drugs. And as we've also discussed on last week's show, the reality is that medical and healthcare costs increase at a much greater inflation rate than the general rate of inflation. Since 1948, they've grown at an average annual rate of 5.3% compared to 3.5% for the CPI index. That means that healthcare and medical costs are basically doubling about every 12 years. So, if the cost of full-time in-home healthcare, for example, why do we talk about in-home healthcare? Because I know that nobody wants to live in a convalescent home if they can help it. So the cost for this full-time in-home healthcare today is roughly $150,000 to $200,000 per year, depending upon where you live. That means that by the time you get to an age, if you're 65 years old now, let's say, by the time you get to an age where you might actually need full-time home health care, that cost might have risen to between $600,000 and $800,000 each and every year. I saw this firsthand, this danger of underestimating the rising cost of health care, just over the last couple of years. I was acting as power of attorney, as it turns out, for an aunt and uncle of mine who were approaching and then ultimately in their 90s. Like a lot of people, their number one goal above anything else was to be able to stay in their home as long as possible, really throughout their entire life. And you know, they had a decent amount of assets in the past and were able to afford full-time home health care for many, many years. But what they didn't realize was that as they were depleting down their money, they got to a point where by the time both of them passed away, they were literally only about 6 months away from completely running out of money. After which time they would have ended up in a nursing home. They would have been forced into a nursing home because they could no longer afford their independence. And under the circumstances, you know, many looked at their passings as a blessing in disguise. They at least were able to fulfill their goal of dying in their own homes. Now, that's obviously a pretty sad case. It's a personal story that I have, but it really underscores the potential impact of healthcare costs and why this is such an important issue for me and why it should be such an important issue for you. And yes, why it's one of the 7 biggest retirement challenges. Now, it's time to welcome back Scott Wardell, author of the book Retiring in Turbulent Times. So one thing that you mentioned, and I want to bring it up here, I asked you to bring back your magic wand. Do you have your magic wand? Is it there? I can't see it.
Do my best. Do my best.
You said that not only do you need to reset their thinking from accumulation to distribution, that is our income generation members, those approaching retirement, But also you said reset their thinking about taxes.
Right.
Talk to us about how you do that.
Absolutely. First of all, people come to their retirement planning with certain perceptions on how they're going to set it up and what might work. And one of the things that we discover a lot, and first of all, with the new tax change, we would like to immediately run an analysis for people that says, okay, here's how you personally are affected by the new tax bill, whether your taxes are going to go up or down. But I'll tell you one quick little story. I had a new client I was working with, and he was brand new to me, and he came in and he said, you know, would you take a look at my taxes? Something went a little awry on them this last year. I said, sure, I'd be delighted to. Let's take it. I said, what's the concern? He said, well, my tax bill went up by about 20%, and I didn't feel like anything really was that different. And so I said to him, wait a second, did you turn 70 and a half this year? And he said, yeah, I did. And I said, okay, so you took a required minimum distribution, and he was in that space that so many are in, where frankly, when he received one more dollar of income than he had the year before, it pushed, in some cases, 50 cents, in some cases, 85 cents of Social Security into that taxation spot as well. So he got $1, he paid tax on $1.85, and it just completely blew up his tax situation. Well, as you know, David, we work a lot on cash flow. When you're retired, cash flow is king. So if all of a sudden you got an extra $2,000, $3,000 bill because much more of your Social Security got taxed than you thought, that is something you need to know in advance and control if you can.
Well, you know, that's what I always feel like. You know, in my family, we pay all the taxes out of my pay, and my wife gets to keep all hers. So essentially what's happening is I'm getting $1 paying tax on $1.85. So I know how it feels. That's not very good, right?
You're right there. You're right there.
Now, are most people, you know, in the minute or so we have left, tell us, you know, are most people a little better off or a little worse off now with the new Trump tax plan?
Well, I would say that we've probably run 25 or 30 specific analyses since the tax bill was proposed. And I would say of those, in my client group, probably about 80% have got some fairly substantial tax savings from it. I would say between $1,500 and $2,200 has been about the average amount of actual tax savings. And one of the interesting things is a lot of people would report to me that they were itemizing, and then when I looked on their tax return, they actually were taking the standard deduction. So now that the standard deduction is doubled, it made a big deal for them.
Yeah. So the majority, I find the same thing, that the majority seem to be in a little better situation, which is good because it stretches their money a little further. You know, we don't spend pre-tax dollars, we spend after-tax dollars. So,
that's
Scott,
right.
I really appreciate you joining us today. Where can people find Retiring in Turbulent Times?
Well, we have it on Amazon.com, so they can go to Amazon. They have to put the words in precisely, though, Retiring in Turbulent Times, and it'll pop up, and they can buy it right there.
I love it. Before we go, one quick thing. Can you please pronounce the name of the state that you live in for us?
Minnesota.
Okay, a little lag on the O. I love it. Scott, thanks so much. It's been my pleasure. You stay with us, too. We'll be right back here on The Income Generation. For the first time in recent years, Social Security had to dip into its trust fund, to dip into principal to pay for Social Security benefits this year. However, most believe it's no cause for immediate alarm. Why? Because there are enough reserves in the system to fully fund the program through 2034. After that, if nothing is done to reform the system, it's estimated to only be able to cover about 77% of promised benefits. But even at 100% of promised benefits, for most people, Social Security simply isn't enough to meet their retirement income goals. That's why maximizing your benefits is so incredibly important. And it's another one of the biggest challenges facing retirees today. As most people know, the earlier you start taking your benefits, the less you get. So if you take them early, you need your assets to be generating enough interest and dividends to supplement the Social Security income. On the other hand, if you decide to delay taking Social Security benefits in order to get more, then you need to fill the income gap from the time you retire to the time your benefits kick in. Well, in either case, you need an asset allocation that minimize your odds of spending down principal or of incurring a major loss. So here's an example. Let's say that you have $1 million in IRA savings. You decide you're going to retire at age 62, but you delay taking your Social Security benefits until age 70 in order to get the highest amount possible. Now, let's say you had that $1 million sitting in a bank and just decided to leave it there. In today's low interest rate environment, you'd be lucky to be earning 2%, which is $20,000 a year annually. Odds are you'd have to spend at least an additional $20,000 per year each and every year out of principal in order to make ends meet. In other words, in order to replace essentially a $40,000 Social Security benefit. If you did this over an 8-year gap, that 20-year deficit would really add up to $160,000, therefore dropping your nest egg down to $840,000 by the time Social Security kicks in. Now, taking it a step further, you could decide to leave your $1 million under a mattress earning 0 interest and withdrawing the full $40,000 over 8 years. Now, if that were to happen, now your nest egg is going to come down to $680,000 by the time you're 70. Why? Because you've taken everything out of principal. So obviously, that wouldn't make a lot of sense. So if it doesn't make sense, why did I mention that silly example? Because let's say alternatively you said, well, I don't like the mattress and I don't like the bank, but you wanted to leave your $1 million in the stock market, be it individual stocks or stock mutual funds for those 8 years. And then, boom, another major market drop occurs similar to the two that have already taken place since the year 2000. Remember, the first time the market fell, it fell by nearly 50% from 2000 to 2003 and didn't get back to 2007, so it took 7 years to drop and come back to its previous peak. The second time, it was 60%, and that time it took 6 years to drop and to recover. Now, if you're a 62-year-old retiree taking assets for 8 years and you happen to get caught in the next 7-year downdraft, it means that each year the market drops or is below where it was at age 62, you'll end up selling more shares of your stocks, your stock mutual funds, to take the same withdrawal that you need to replace those Social Security benefits. That means even when the market does come back within 7 years or so, by the time you hit age 70, you still will not even come close to getting all your money back. In other words, it'll be worse than that crazy, silly example of keeping your money under the mattress. You might, in fact, have only somewhere between $300,000 and $400,000 left after the 8-year period. You will have cannibalized approximately 2/3 of your nest egg. A lot worse than if you'd left it under the mattress. Here's the point. You have to be conservative, but not too conservative. Not so conservative that you're not earning anything and spending down principal. However, if you're too aggressive, then you incur the risk of the next major market loss. A similar danger exists with regard to another one of retirement's biggest challenges, known as required minimum distributions, or RMDs. Now, as you may know, the government forces you to start taking distributions from your IRA account starting at the age of 70 and a half. Now, these required distributions, RMDs, start at about 3.7% of the balance, but that percentage increases every year after age 70 and a half. The important question to answer regarding RMDs is this: is my asset allocation generating enough interest or dividends, not growth, interest or dividends, to satisfy my RMDs without touching principal? If you're using a strategy in which you satisfy your RMDs from capital gains or capital appreciation in your market-based investments rather than interest or dividends, then it's really no different from taking the money from principal, because ultimately that's what you'd be doing. Why? Because again, sometimes when you invest for appreciation, you end up getting depreciation instead. You count on growth, but you end up getting shrinkage. Now, admittedly, this was less of a danger years ago, at least on paper. In the 80s and 90s, during the best long-term secular bull market our country's ever seen, investors could conceivably have satisfied their RMDs completely from capital gains rather than dividends without harming principal. But since the year 2000, the markets have been different, and frankly, the opposite has been true. That's when the long-term secular bull market turned into what I believe is still our current long-term secular bear market, ushering in those two major market corrections of more than 50% and the continuing threat of a third major market drop. So, how much is enough interest or dividend to satisfy your RMDs? to supplement your Social Security and satisfy all your income needs over 30 years of retirement? And what's the best way to get it? Well, as you could probably imagine, we're going to talk about that in a bit and how it relates to the final biggest retirement challenge. But for now, let's welcome back Geoff Small. He's here to talk more about goal setting and so many other things of which he's knowledgeable. He lives and works in Melbourne, Florida, has over 30 years of experience as a financial advisor. Geoff's a highly sought after speaker who can be seen regularly on shows like Fox Business News, Bloomberg Radio, and his Amazon best-selling book is called Turning Financial Planning Right Side Up. But the most important thing is he's a very close friend of ours, of mine personally, and he's a repeat guest here on The Income Generation. Geoff, welcome back.
Hey, it's great to be back on The Income Generation, Dave.
So, for the one guy that made it to the #1 spot on Amazon with your book, when I only made it to the #2 spot, I guess I've got to ask you all the tough questions and challenge you here today. First question, the markets. You know, the markets are high, they've been high, they're showing weakness. We now have 6 months of kind of a narrow sideways channel in the market, not moving forward. How does that apply to our topic today with people's longevity and people's need to be careful?
Well, it really applies to longevity because what retirees don't want to go through is something called the catch-up game, because at some point we all know, even the average consumer from Main Street knows, the market is going to pull back. And so that has a dramatic impact on your money, especially when you're retired. And when you're retired, you're not going back to work to reaccumulate. So you're probably better off avoiding some risk at this point or taking the majority of risk off the shelf.
But that's a general statement, but I guess my question becomes, how does that apply today? Do you think the risks are higher today because you see what's happening in the market? Or do you think there are enough people who just love President Trump that the market's got 2 strong years marching forward? What are your thoughts about that?
Well, that's a long conversation, but in its shortest time frame, Dave, what's driving the market now is not Main Street America. It's not the retiree investor buying stock. It's corporate stock buybacks that are carrying the market. And a few stocks, high technology flyers like Apple and a few other ones, Amazon and Google, that are pushing the market metrics up. And so at some point, corporate stock buybacks will stop. We're on pace for $1 trillion of corporate stock buybacks. Who's going to be buying market stocks when that corporate stock buyback starts to dry up in the next 12 to 18 months? Prices will have to adjust downwards to incentivize buyers to come back into the market. And so that's the #1 driver in the market today is the demand from corporate stock buybacks, which basically they've tenderized the market. They've peppered it for the last 8 to 9 years so the market will grow. And they've been buying $50 billion a month of their own stocks back. At some point, they just can't keep doing that. Yeah. Now, with the Trump tax cuts, they got a huge incentive to buy back billions of dollars of more of tax cuts this year.
But it's not, like I like to say, it's not going to last forever. And eventually, when the music stops, like the great game of musical chairs we both played when we were children, somebody's going to be stuck without a chair, and it's probably not going to be the institutional guys. It's probably going to be the little guys. So, Geoff, please stay with us. We'll be back for another segment. You stay with us, too. We'll be back with a lot more from Geoff Small from Arbor Financial Group. For all the different options there are out there, the truth is that everyone really wants the same thing from their investments. You want maximum return with minimum risk. The important thing to ask yourself is maximum return for what purpose? Is it for a lump sum purchase? Is it maximum return to leave a good inheritance, a good legacy? Or is it maximum return for your retirement income, either present or future? Well, for most people watching the show, their primary goal is maximum return for income. But because no investment is 100% risk-free, that makes risk another one of the biggest challenges facing retirees today. But it's a challenge not so much because there aren't ways to significantly reduce your investment risk, but it's a challenge instead because most people believe that the only way to reduce your risk is to reduce your potential return, and vice versa. But as far as investors at or nearing retirement age are concerned, it isn't necessarily true. In fact, in many ways, the opposite can be true. Here's a simple formula that you're probably aware of, but I'd like to share it with you anyway, as I do from time to time. that explains why this is so true. When it comes to your investments, total return is a product not just of growth, but have income and growth. Now, growth is measured, of course, in capital appreciation, while income is measured in interest or dividends. Now, there is a time in your life when it makes sense to focus more on growth, focus more on the G than the I. When you're still fairly young, in your 30s, maybe even well into your 40s, you want to grow your portfolio as much as possible and build your nest egg for the future. If you think of it in terms of sports, it's like the first 3 quarters of a football game, where the team is focused on offense, trying to get points up on the board as insurance for the future. But once the future arrives, and you're in your 50s or 60s, the entire game changes, just as the game changes for a football team oftentimes in the last quarter, especially if they're ahead by a decent amount. At that point, a smart team shifts its focus from offense to defense and to protecting the points that it's already earned. For investors over the age of 50, income generation members, shifting your investment focus from growth to income is a similar smart strategic move. Again, why? Because when you're investing for income, you're typically investing in vehicles designed to significantly reduce the risk, your exposure of a major loss due to market volatility, to protect your principal better, and most importantly, to generate income and dividends at competitive rates. That's why the belief that increasing your return requires increasing your risk is wrong for investors in or near retirement. Increasing your return on the income side oftentimes means actually reducing your risk. Going from the G to the I can lower your risk, not increase it. And yes, the proof is in the numbers. Since the turn of the century, the average annualized return for buy and hold stock market investors has been about 5%, factoring in both the G and the I, factoring both growth and dividends. By comparison, however, many income-based investors whose portfolios have been properly managed during the same period have achieved close to 5% in just the I, the income component, annually, but greater than 5% average return average annualized return, that is, when you factor in the I plus the G. And with those kinds of returns, many have been able to strategically reinvest the income that they didn't need into other income-based strategies to grow their portfolios organically. Or as I like to say, grow them the old-fashioned way. In other words, reducing their risk has actually helped increase their total return in terms of primarily income, but also to some degree, yes, growth. We're here with my good friend Geoff Small from Arbor Financial Group in Melbourne, Florida, and author of the book, Turning Financial Planning Right Side Up. So I have to ask you, real quickly, what's your take on this trade war? Do you think this trade war could be the one thing that maybe tilts the market when it finally gets out of this trading range and makes it go downward, or do you think we can actually win a trade war?
Well, I think we can win the trade war, Dave. I mean, the EU has already capitulated. Mexico is starting to capitulate and give in as well. Canada will be next, and then China after that, because the economics were at such a disadvantageous state for the United States that things have got to change.
So you think, okay, so you think we can win it, but you're saying you don't think it's enough after this bull market recovery having lasted now almost a decade since 2009. You think even though we could win a trade war, it may not be enough to save us from that next market drop.
No, the trade war is going to be like a pinprick on the economy. We might see, even if we go to a full-blown trade war with China, which is really the only place there could be a trade war at this point, we might see 0.5% shaved off of GDP. That's not going to rattle the stock market. It will rattle the Dow 30 and some of the largest multinationals that do business in China, but the effect will be short-term and relatively benign. The real pullback will occur once there's going to be less buyers in the market, and that'll happen when corporate America stops buying back as much stock as they're buying now. Like
Mohammed Al-Arian told me on a show just a few weeks ago, the days of buying ETFs are over. It's really about stock picking right now, and that's what he meant. Those multinationals are the ones that could get hurt the worst. So when we come back from the break, I want to talk to you about something that's near and dear to your heart, and that's being debt-free, having a little bit of debt. I know you well enough to know that you're so tight that you squeak when you walk. So we're going to be back to talk with debt more and making sure you don't have a lot of debt into retirement with my good friend, Geoff Small. Stay with us. We'll be right back on The Income Generation. Welcome back to the show, and also a big hearty welcome back for our good friend, Geoff Small. So Geoff, debt. I think all of our income generation viewers know why it's important to be as debt-free as they can going into retirement, but why is it so hard for many people?
Well, Dave, I mean, people get 30-year mortgages, and it doesn't matter what age you are. A 90-year-old man can get a 30-year-old mortgage today from Bank of America if he wants to, because they're not age discriminatory. But folks have to be more disciplined to get out of debt before they retire if they want to have a retirement that's based on any type of financial longevity potential.
And it's harder today than ever before, because today, I don't know if you see this, is talking to financial advisors every day as I do, or talking to individuals, clients every day as I do. But the reality is that with people now having a greater and greater percentage of their wealth in 401ks and IRAs, it's not like they can just go ahead and take $100,000 and pay off all their debts the day they retire. I mean, they'll get killed with taxes, right?
Well, there's no doubt. Paying off a mortgage from a 401k or an IRA is not usually an option. So what they need is a long-term strategy years before they retire to get that mortgage paid off without supplanting or hurting their savings rate. So there's many creative ways to pay off debt. But you definitely, if you're not retired yet, you want to focus on getting your debt down to zero so you can retire debt-free. Then you'll have a financially successful retirement.
That's great advice, and that's great for us as left-brain financial advisors to say, but it's easier said than done. So, Madison Avenue has huge control over us as individuals, and it's so hard. You want what you want to spend money, we're tempted with all these things. Psychologically, I mean, how do you coach people to really make that happen? It's one thing to say it, but it's another thing for people to implement it.
Well, I think, everybody's situation is different. So there's lots of customization and tailoring that goes on, Dave. But it's the secret sauce isn't that secret. If you're going to save money and you want to accumulate and you want to pay down debt, you have to save more than you spend, which means you've got to spend less and save as much as possible. And as a general rule, you want to try and save 20 to 25% of what you earn after 401k contributions, after taxes, and after, of course, everything else.
I guess psychologically, you just have to focus on, hey, how do I, what my retirement could look like and what it could look like if I stay in debt, and hopefully use that as a motivation. It's like going on a diet, same thing. It's like you always want that piece of pastry, but it's not going to help you with your diet. It's just focusing on the goal, I guess. No silver bullet, right?
No silver bullet, but I don't get the pastry analogy. Are you trying to tell me something?
We'll save that comment for off the air, but Geoff, so since I just must bow to you because you were #1 on Amazon, they can find your book at Amazon, correct?
Correct. Yeah, it's on Amazon. So it wouldn't be #1 there, Dave. It's on Amazon. That's correct.
Turning Financial Planning Right Side Up. Geoff, once again, my pleasure. And you stay with us. We'll be right back here on The Income Generation. I'd like to thank both Scott Wardell and Geoff Small for joining us for another episode of The Income Generation. Of course, I'd like to also thank you, our new and returning viewers. Life is filled with challenges at every stage, but the challenges we face in the years just before and during retirement are among the biggest of our lives for many people. How we prepare and deal with them could mean the difference between a secure, happy retirement and one filled with struggle, worry, and regret. So with that in mind, please think about the specific challenges that we've discussed on today's show and ask yourself, am I prepared for these challenges in the best way possible? Do I fully understand the scope of each challenge? And do I have the right advisor to help me meet those challenges and to achieve my goals? Going further, please ask yourself, is my financial strategy equipped to meet my income needs for up to 30 years with minimal risk of spending down my principal and or running out of money? Does it protect me against the eroding effects of inflation over that 30-year period and sufficiently account for the even greater potential impact of rising healthcare and medical costs? Is it properly allocated to maximize the value of my Social Security benefits and to minimize the impact of my RMDs, my required minimum distributions? And most importantly, is it designed to minimize my risk of a major loss due to market volatility, to protect my principal, provide dependable income, and the opportunity for organic portfolio growth through strategic reinvestment? If the answer is no to any of those questions, or you're at all anything less than 100% sure, I encourage you to take action now. The sooner you start preparing for retirement's greatest challenges and doing it in the right way, the better your odds of meeting every single one of them. Thanks once again for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And guess where you can do it? That's right here on The Income Generation. I'm David Scranton. Thanks again, and we'll see you next week. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.